Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Omar Aguilar of Schwab Asset Management writing, we are getting some corrections within the frothy areas of the market. It is time to use volatility to rebalance exposures to reduce concentration. Omar joins us now for more. Omar, always good to get your thoughts on things, sir. Let's get into it. What would you be reducing right now? What would you be taking advantage of?
Well, we have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s. And think, the exposures that people may have had to the traditional and momentum, type trades are very high. And I think we have been encouraging clients over the last, 2 months to try to use these periods of volatility to try to reduce exposure to that momentum trade. We have seen these, that can actually go very quickly as, the AI trade, the expanding on CapEx, increasing CapEx, continue to just emphasize that sort of mega cap, dominance that we have seen. One of the statistics that we keep on showing is that, only 17% of stocks within the S&P 500 have been able to outperform the market this year. So that tells you a lot of that level of concentration that, if we go back in history, when it comes down to momentum trades, they tend to be unwind very, very quickly. And we have seen some of these head fakes already over the last, couple of months.
Omar, I've heard this argument repeatedly throughout the whole year. And if I listen to people as they offer that encouragement to move out of these names, I would have missed out on the rally because that's what supported the index. Omar, what are you suggesting people should buy instead?
Well, I think if you look at the fundamentals of the economy, if you look at what is happening, we have been encouraging clients to just take this barbell approach and take a look at the fundamentals of what is the corporate earnings growth that you see on these areas. Normally what you see in these, probably not very clear economic picture because of the lack of data. We have seen this softness in the labor market. We have seen softness in the housing market. We clearly see this deceleration of economic growth when inflation stays, high. And what that would recommend is for people to start moving into the cyclical part of the market and being more defensive. We're not necessarily thinking that the economy is going to crash or is going to go into a very hard landing, but clearly we see, the potential for these to go to a slowdown, and only companies with strong balance sheets will do. We actually saw underperformance of dividend payer stocks, this year. This is the opportunity to take a look at those companies that can actually do well. So starting to go into that part of the market is started well. Interest rates are probably coming down. They already started the Fed, reducing rates. That also provides a little bit of ability for cyclicals and sort of mid-sized companies to start doing well. And I think I will emphasize the fact that, earnings potential is sort of the biggest part of what the market might look like.
Omar, does defensive mean something different today than it meant, say, 5 years ago?
Stability, Lisa. Stability is what we actually think about defensive. It's not the traditional consumer staples, utilities trade. And in fact, utilities tend to be more driven by AI these days than what is the traditional AI. But it's really more stability in earnings, what we actually think about being defensive. Higher quality names in terms of profitability and profit margins, so stability is a big part of it. You think about it, companies that did very well through all this period of uncertainty around tariffs and around, labor market cost increasing, et cetera, were those companies that had very good, profit margins. So they are the ones that are able to still not necessarily pass through the increased prices to the consumers. Those companies that are squeezing their profit margins will have no choice to actually, pass through those prices to the consumer. So we clearly emphasize that ability of continue to have sustainability of earnings, quality of earnings, and healthy profit margins.
A number of people have come on the show this morning and have talked about how there still is quite a bit of dynamism under the surface, and you talked about the cyclical sides of the market that could potentially do better, especially if the Fed cuts rates again next month. At the same time, people are seeing more inflationary pressures come in, whether it's from stimulus efforts, whether it's from the energy costs, and I'm just wondering whether increasingly the idea of diversification is starting to look very different for you, with the bond market maybe not having the same kind of profile as it has in the past.
Well, diversification is clearly the name of the game, and that has not going to change. I think the main concern that we continue to have is the fact that, yes, as we see in the bond market, a steeper yield curve, when we see inflation expectations continue to rise, and that is a big component of what I think, we may see. We're starting to see a little bit of movement on the credit market. Clearly, this is the time where, diversification and maintain the levels of quality in the bond selection is actually a key part of it. I don't necessarily think that duration is sort of at play in the bond market at the moment, but I guess the expectations have been set. But I think the shape of the yield curve and the movements that you have as you see, sticky inflations, and you see a continuation of that expectations that we're going to have a more steeper yield curve is sort of a big part of what we are encouraging clients to look at. On the equity side, again, earnings, potential and diversification suggest reducing the concentration. And I cannot emphasize that even more because, the level of concentration that there is in terms of the majority of portfolios, it is, pretty high. And I think diversifying away from it, even if it means that having to buy some of the companies that have been underperforming this year, is actually a healthy thing to do for investors.
Omar, can I just follow up? Because we get this argument so many times on this program, we can't just buy something else for the sake of buying something else for the sake of reducing concentration risk. Concentration has been a theme because that's where the earnings power has been. And Omar, I'm trying to understand why you want to go somewhere else. What is it about being somewhere else if it's just for the sake of being somewhere else?
Well, I think the fundamentals or the corporations, tend to basically look at, where the market and the price tends to be driven is about that earnings potential and the free cash flow generation. And yes, you're right. The companies that have done very well so far, tend to be driven a lot by that, earnings potential and free cash flow generation. And in many cases that have provided a good performance. Now, when you look at what that means in terms of sustaining that rate of earnings potential, that's where the risk, stays. And therefore, the size of that, concentration, when you have companies that could be between 3 and 4% of the active risk that goes into your portfolios, that tends to be fairly risky. Now, there are areas that are still also generating significant amount of earnings that are significantly potential for free cash flow generation that are not, that high levels of valuation. So looking at those undervaluation companies that still have the same characteristics, the same factors as some of the others, but you don't necessarily have to go into these very high multiples, is actually a very healthy thing to do.
Where do I find them, Omar? Where are they?
Well, they are, significant in areas in infrastructure. They're significant areas, within even technology. If you actually look just at technology, excluding, the Max 7, there are components within, technology that are still pretty good, that their capex expenditures still to increase. Their ROEs and the ROAs continue to just be very healthy. There are still, this is the time where stock selection matters and looking at factors that drive performance, matter. You actually see areas within, the cyclical markets, whether it's in materials, whether it's in energy, in those, areas, there's very, very good opportunities that you can have. Again, we have been talking about it, I've been talking into your program about, going into small cap. We still think that it's early to go into small cap. There still need to be some structural pieces that could benefit those small cap companies. You don't necessarily have to go all the way and try to overweight small cap, but then looking at those, that tend to be, multiples that are decent with earnings potential and free cash flow generation is the way to go.
Stay with us. More Bloomberg surveillance coming up after this. An increasing number of Democratic lawmakers calling for Senate Minority Leader Chuck Schumer to step aside after failing to stop members of his party from agreeing to a Republican deal to reopen the government. Joining us now, Henrietta Treyz of Veda Partners. Henrietta, a reality check for politicians in Washington. They've had two already. They had one 12 months ago in the general. The general public weren't happy with affordability, the cost of living in this country, and looked to Republicans to try and fix it. And they're willing to vote for whoever is going to come out with a good idea. And their ideology is not cemented. It's not fixed. They'll shift from one party to another with ease. You and I have talked about that. How do you think that sets us up for the midterms next year?
Yeah, I mean, that's exactly what last Tuesday's election showed. It wasn't just that Democrats came out. The exit polling shows that it was Trump voters who went for him in 2024 who swung right back to the Democratic Party this cycle. And that's a combination of the president's economic policies more than anything else. And so what Democrats have done here with this shutdown is not keep an eye on affordability, which was, of course, the talking point of the Tuesday elections, but the inflation, grocery prices, healthcare prices. I mean, I'll be honest, you guys know I don't like healthcare. Even I know now that the insurance premiums for people over the age of 60 are going to increase $919 as a result of not extending these ACA subsidies. And we just spent 41 days saying that back to back. We're going to have a vote on it in December, and we'll do it again in January. So I think that for the Democrats, just keeping this message alive is outside of the Beltway, sending the message that has just won an election and looks like it'll be a repeat of 2018 based off what we're seeing in the polling.
To build on that, Henrietta, do you think that this shutdown was futile for the Democrats, or do you think that it actually yielded some political benefits?
I think it yielded a lot of political benefits. I'll cover a couple. Number one, I think it's setting up Schumer to step down and pave the way for the senator from Hawaii to come in and be the next Democratic leader in the Senate side. That's, pretty plainly something that's building within the Democratic conference on the Senate side. I think that's something that Schumer is ushering in himself. And he took a lot of arrows by voting against this bill, by agreeing to let the 8 moderates cross the line. That's exactly however many you needed. I think that's what leadership does, especially on the Democratic side. You've seen it in the past. Joe Biden just did it last year. On the messaging side, think about where the numbers are. President Trump's approval rating has cut again in half. He went from -7 to -13 in the polling averages just since October. And on the congressional ballot, in generic polling, the Democrats went from +1 in the generic ballot on October 1st to +4 now. That's enough to get you the midterm House elections, and that's the goal of leadership.
There's a lot of time between now and the midterms, and it really includes the beginning part of next year when we could potentially get tax rebates. You can call them the tariff dividend. You can call them whatever you want, but a lot of people are expecting more money in people's pockets come January and February. How much do you expect that to really skew things the other direction, back toward the Republicans heading into the midterms?
I mean, why do you need a $2,000 rebate? What's the problem? Is the inflation still rising? Is affordability still a problem? Didn't we just pass a one big beautiful bill with $3.5 trillion of deficit increases? Why do we need a $2,000 dividend check that, by the way, will not be paid for by tariffs because the tariffs don't bring in that kind of revenue? In the 2000 CARES Act, when we passed the exact same kind of rebate check Trump is talking about right now, it cost $292 billion. The tariffs have brought in $89 billion. If we give $2,000 to every, eligible American, that's a $400 billion spending provision. So you're going to increase the deficit to provide tax cuts to Americans who are suffering from inflation because of tariffs. I don't think that's a winning message.
At a time when there's a question mark over the policy itself and whether it withstands the scrutiny of the Supreme Court in the coming month as well, Henrietta,
exactly.
Where do they have space to offer some kind of giveaways and change policy?
It's amazing because when I speak with Republicans, they plainly don't want to go through the very difficult activity of passing a fiscal year 26 budget and a fiscal year 26 reconciliation bill. Democrats wouldn't want to either. It's extremely difficult. Voters opens up all your members to vote-a-rama. But what you could do is you could get 60 votes to extend the ACA subsidies. And then think about what we just talked about. You get every family with two 60-year-olds in the house on Medicare, Medicaid, you can get $919 for each of them back in their pockets. If you are a household with kids, with 20, 30, 40-year-olds, the ACA subsidies get extended, you get $200 a pop. So there's a pretty easy path to 60 votes if you want it. And we'll have those votes in December and then again in late January. And if you want to stimulate the economy quickly, get money back into consumers' pockets, the ACA subsidies is a really fast way to do it. And a lot of Republicans would like to see that too. Look at Alabama, Louisiana, Mississippi. That's where those voters are.
Stay with us. More Bloomberg surveillance coming up after this. Skelly of Morgan Stanley writing, while the fundamental backdrop for the market has improved from the panic-stricken spring, at current valuations, investors are not being compensated for a high degree of policy and earnings risk. Dan joins us now for more. Dan, good morning.
Good morning, John.
Do you think that captures the pushback we've seen across several single names over the past few weeks?
Definitely. And by the way, I think the volatility and the rotation that we're seeing among single names is healthy. I mean, the idea is if everything was going up euphorically, then maybe we could talk more about a bubble. But you are seeing the market reward winners and penalize losers. And so I think that's a healthy trend. I think, frankly, there's seemingly a bubble and everyone's guessing whether or not we're in a bubble or not.
A bubble in bubbles.
Correct.
Not in the credit market. Credit market's wide open to support some of this spending. Do you think that remains the case?
I think that remains the case and is likely to be so for the foreseeable future. You've seen some of these bond deals way oversubscribed, as you know, in the last couple of months. And so we're just not yet at that point where things are starting to look more concerning.
Bubble of a bubble? Bubble in bubble talk?
Bubble talk.
Okay, honestly, this is so derivative. I'm having a hard time.
That's not my phrase.
The rate of increase of the bubble in bubble talk, I know, but it's true. There is this feeling that right now there is a lot of fear out there. I just want to go back to the point that you made, that it's healthy to see swings like this. It's healthy to see swings in one stock name of valuations, market valuations of $264 billion in one day. The idea that we saw that kind of gain just on Monday alone in the likes of NVIDIA after seeing $200 billion lost in one day. How is this healthy? Doesn't it really point to concentration risk in another kind of way in the index?
Sure, and it's an excellent point, Lisa, and so I'll say a couple things. So first is what I'm describing is among the Mag 7 themselves, you saw a handful, half of them up on earnings and half of them down on earnings. And so I think that's really what we're looking at. But I think to your point in terms of absolute market values, it certainly speaks to the crowding that's happened not only this year, but going back 15 years, really since 2008. We've seen this winner-take-all phenomena for almost 2 decades now. And it speaks to just how much the market share winners have differentiated themselves versus everyone else. Last point, you referenced 98, 99, which we're starting to hear more and more of, obviously. Let's not forget that in the stretch from kind of the fall of 99 to the spring of 2000, the NASDAQ doubled over a 7 or 8 month period. That is truly what a blow-off top looks like. We haven't seen that of yet.
There's also this question of how far the AI trend is diverging from the underlying economy.
Sure.
And we keep going back to this, how difficult it is to get a gauge on what's happening with people feeling pretty negative on the economy, pretty negative about their spending power, at the same time that you're seeing these runaway gains and these expectations for all this profitability and efficiency.
Sure.
How do you square that?
So it's a K-shaped market economy. It's a K-shaped socioeconomic recovery post-COVID. Everything is diverging. We wrote about this recently in our letter, talking about the market is not the economy is not the market. And when you look at the changing nature of this economy, really since COVID, but going back, I'll say a decade plus, it's a services-led economy. All we've done is wring our hands around tariffs and trade this year. Trade is 11% of GDP. This is a services economy. AI spending is being funded largely by cash flow. So we're seeing that as being somewhat more insulated from ebbs and flows in the economy. And increasingly, it's a high-end consumption market. I mean, one of the things we haven't talked about enough, we think, is that 10% of the population controls 40 to 50% of the spending. And that's a cohort that's been reflated in terms of wealth effect, exposure to asset prices, houses, and stock markets. And so we're seeing that bifurcation across not just the market, but every component of the changing nature of our economy.
Does that make you want to expand out into some of the areas that are more susceptible to spending, whether it's on the high income, which seems like an AI trade at this point, or whether it's on the lower income, this sort of bet on some sort of cyclical improvement?
very selectively where there's also a fundamental catalyst. So we don't want to just make macro and factor bets. We want to also marry that with some type of idiosyncratic catalyst in whatever stock call or sector call you're making. For example, financials. Obviously, there's a lot of macro inputs, rates, the economy, lending, but at the moment, idiosyncratically, there's a capital markets recovery. There's deregulation coming from the administration. So you always want to have some type of fundamental catalyst. Lastly, as we've seen expectations around the Fed dial down for December, we were almost 100% priced a month or two ago. Now we're 60% priced. We've seen all of those small cap and higher cyclical stocks trade off as well. So tell me what the Fed's going to do in December, and I'll tell you if I want to make that trade.
Well, there's some excitement that maybe we'll get some economic data. How relevant is that data to this market?
It's super relevant, and all of your guests and you all have been talking about this concept of flying through the fog, which we've been doing with the government data. We think basically trying to triangulate all the different inputs in terms of private market surveys and providers, we actually might see a slight tick up in the unemployment rate when we come out of that fog in the following weeks.
Is that enough to hold back the index? Because we've had lousy job numbers all year, and the stock market's been just fine.
Probably not. So it's a great point. Probably not, and the index is going to continue to follow the AI sentiment and the earnings trend, which continues to be really strong.
So what's your highest conviction trade heading into year end?
So heading into year end, I have to say that the AI power and the AI infrastructure basket, which has sold off more recently, still looks really, really compelling. We came into this year expecting capital spend to be $300 billion. It's tracking towards $500 billion. But in terms of what we heard from the tech players over the last month, we're going to look at maybe $700 billion going into next year. So if you think downstream in terms of all the industrial power and different utility components, we think that trade still looks really compelling. And it's come off a little bit off the highs.
Stay with us. More Bloomberg surveillance coming up after this. Venu Krishna of Barclays maintaining his bearish S&P 500 year-end target of 6450 as earnings season continues. Venu joins us now for more. Venu, good morning, sir.
Good morning.
6450. Justify yourself, my friend.
So that is a base case, and we have an upside case of 7,000. So I would argue that you look at it more as a range at this point in time. But listen, it's just that the market has been moving ahead. So we moved our price target in early September, right? And so already the market has moved ahead. So, we remain cautiously optimistic. Actually, looking into next year, we are more optimistic. We expect earnings to increase, double digits, 10 to 11%. So I think, and the earnings season right now is extremely robust. I mean, this has surprised even us to the upside. We were more optimistic, but this is building momentum from the second quarter. Yeah.
What's happening in corporate America that's generating double-digit earning growth? What are these companies doing?
So I think one is, if you look at the tech companies specifically, they're already monetizing AI to a decent extent, and that is showing up in their overall profitability. So they're laying off people, and yet they're highly profitable, and they're still spending. So that's one part of it. AI, of course, is being tested and adopted to varying extents. Still, enterprise usage is quite low. But one of the interesting things we are noticing right now is operating leverage is improving to a broader cross-section of industries. In other words, companies are doing a better job at cost control relative to their sales growth. Now, that has been our fundamental concern, outside of tech especially, that there's been a problem, pressure on margins. So it doesn't mean it's good across the board. Some sectors are still having a tough time, for example, staples, discretionary. But overall, we have seen an improvement in cost control relative to sales growth. So more positive operating leverage in the system.
It sounds like you're kind of leaning into the bull case. At what point do you just reject the base case and go with the bull case heading into year end?
Good question. So if you wait for 2 weeks, you'll know the answer.
So in other words, you might pick up the base case in 2 weeks. Okay.
So, the point is, we normally come up with our outlooks, sometime toward the second half of November, where we, update our numbers for this year, next year. So directionally, it's very evident that the U.S. is turning out to be strong. So especially when you compare U.S. to the rest of the world, which means Europe and APAC, The revisions are running better, the profitability is running better, the expectation of margins are better, and that's the reason why we trade at a higher multiple than the rest of the world.
You've been traveling around a lot. I don't know how you made it back. Congratulations. But there is this sense that the dialogue has completely shifted from earlier this year, where it was sell America, go into Europe for the promise of growth, the actual spending of Germany. That's flipped. What was the environment like? What was the sentiment like?
Yeah, I would sense, I just came back from Europe, and so there's a certain layer of frustration over there because my trip earlier, I would say in early March, there's a lot of skepticism about US, about tech, about what multiples you pay for it, about AI more broadly speaking. And underlying that was enthusiasm about the fiscal spending expectation out of Germany, for example. So I think what many of them have realized is that they were wrong. So they were right for about 2 months. So there's a level of frustration on that. There's also this fear of missing out. So the question of do we jump in or not? So that's an overall question. But if you just look at the scale, like somebody was pointing out to me, German fiscal spending in Germany over the next 10 years is going to be in a few $100 billion. We are talking about $1.5 trillion in AI capex in the next few years. So the scale of what's happening over here is simply astounding. But I think some level of skepticism I sense in terms of the return on investment in AI. That is, I think, reasonable because nobody knows, which is a fact, as to what the true profitability will be. And that is important not in itself because the scale of spending is so massive that the market is effectively putting 100% probability that this is going to be truly transformational, more so than the 4 other big tech cycles we've had since the mid-'80s. Right? From the PCs to internet to mobile, we're in the middle of cloud, and we have AI. Now, that better play out because that's what the market is telling you is going to happen.
That's why people are so skeptical. I just heard from a Bloomberg subscriber directly. I can share the message with you. We know the enormous AI capital spend numbers, but what we don't know is the return on that capital. The market is discounting that the returns on the AI capex will be significantly superior to the tech companies' legacy returns. Is this really going to be the case? Is it durable? Feels like a stretch. Do you hear a lot of that kind of sentiment on the road?
Yeah, so I think I hear a lot of that. And I think the frustration, the difficulty is literally nobody, even if you talk to tech experts, have an idea about how to quantify the scale of productivity improvement. The other thing is, still a lot of it is coming from having a better cost base, right? In other words, being able to do more with less. But the real use case will also come in the top line itself, which is where in the early stages. And like I said, enterprise usage is still, in the early stages. So I think that skepticism is reasonably warranted. But what I do point out, and I think we have discussed it in the past, that big tech as a group who are doing most of the spending, their multiples have generally been easing over the last 2 to 3 years. So they are earning into the multiples, they're spending. But I think the big question now has also shifted into the funding landscape. So far, all the funding has come from organic cash flows. And in fact, the big tech companies are spending 50-50 on buybacks and on capital spending. But going forward, given the scale of spending, increasing the credit markets are going to be tapped in varying extent, public, private, asset-backed, and things like that. And so that's a question.
Is that good news for stocks?
Well, some amount of leverage being used by companies is actually optimal, right? So you're using a balance sheet efficiently. But it also means that the equity markets now have another source to take a cue from in terms of how risk is being priced, right? And where is risk clearing? And how does it compare to what we see in the equity markets? But if you look at the scale, I think as of now, we broadly estimate that in the tech area, AI related, there's been about, call it 160 odd billion, which has been raised in public and private markets. If you look at the market cap of big tech companies, I'm not even include Oracle in this, it's touching 21 trillion. So I think the scale is very modest. And many of these spenders are highly profitable, but as the scale of spending. So if you tell me that $1 trillion is going to be funded in credit markets, that's slightly a different story, right? And I think that's what people are asking.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal, and the Bloomberg Business app.